先生クジャク
We hear about price to earning or PE multiples all the time, but what do they mean? The price to earnings multiple is a ratio of the share price of a company to the earnings per share of the company. For instance, a company with a share price of 500 rupees and earnings per share of 20 rupees has a PE multiple of 25. While computing this multiple is not difficult, evaluating the multiple can be. Investors debate the appropriate ratio at which a given stock should trade. Should it trade at 5x, 15x, or 25x? While each investor has to arrive at that conclusion for himself, for each company he evaluates, it is important to understand the pitfalls of using this one metric to determine whether the equity shares of a company are expensive or not. The first challenge is whether to use trailing or future earnings of the company. Analysts may use one or both when assessing companies. This is where things get tricky. Imagine a company, let's call it X, has a share price of 1000 rupees. Its trailing earnings per share are 250 rupees. This means that equity shares of X trade at a PE multiple of 4. Your friend tells you he is aggressively buying shares of X as he believes a PE multiple of 4 is too low for this company. He even goes on to tell you that historically, this company has traded at an average PE multiple of 12. The potential return from the multiple simply reverting to this long-term average is tantalizing. Before jumping in yourself, you decide to investigate. When analyzing the company, you learn that raw material prices for X are expected to rise dramatically, almost quadrupling in coming months. Further analysis reveals that this will lead to X earning negligible profits over the next year. That is, X is expected to have future earnings of 10 rupees per share next year. If your assessment of the future pans out, X trades at a forward PE multiple of 1000 divided by 10 or 100. The stock doesn't look so cheap now, does it? This example is common with cyclical stocks, for instance, where earnings in any given year, in and of itself, often offers little to no insight into the future profitability of the company. That is why it is vital to understand both the trailing and future PE of a company. Keep in mind that future earnings may differ materially from expectations, offering both risk and reward. Let's take another example, this time of imaginary company Y. Y trades at a PE multiple of 50, that is, Y's share price is 100 rupees and earns 2 rupees per share. Everyone you know tells you that Y is far too expensive and must correct. 50 is after all far too high a multiple for the business. Once again, rather than blindly believing something you hear, you decide to do your own due diligence. When studying Y, you learn that the company has recently commissioned a new factory that is expected to grow profitability 10 times over the next 3 years. Assume this expectation is met. In such a case, Y's EPS will be 2 times 10 or 20 rupees per share in 3 years. Therefore, Y may be trading at 50 times trailing earnings, but it trades at 5 times earnings 3 years hence. Sufficient growth and profitability may more than justify an optically high trailing PE multiple. Therefore, selling shares of Y today may prove to be a mistake, as the high PE multiple may simply be a function of the immense potential of the company's business. The second challenge with using the PE ratio is evaluating loss-making companies. By definition, for the PE ratio to have relevance, the company must have positive earnings. As a result, it cannot be used to value companies that make losses, such as startups that are building out their businesses, or certain long gestation businesses that have large upfront costs and with back-ended payoffs. The third challenge, and in many ways the most important challenge, is the complications that arise with using a single EPS or earnings data point. In many businesses, the earnings can be entirely misleading. This may be because of fraudulent activity, but it is often a function of the uncertainty of the future of the business. For instance, in the lending business, the earnings can appear high or low in any given time period based on the provisioning done by the lending institution. In insurance, the insurer may inadvertently under-provision or over-provision, leading to unintentionally misleading data. In both cases, it may be multiple years before the true picture emerges, and in the interim, the reported earnings may be inadvertently higher or lower than they should be. Also, a given year's earnings may be affected by one-offs or exceptional items, such as a sale of some land, which can materially impact earnings positively or negatively. This may lead to the PE ratio looking surprisingly high or low, but will not give you the true picture of the earning power of the underlying business. The point to remember is that the PE multiple of any stock is just one of many data points that must be considered when valuing businesses. Also, it is a point-in-time metric. That is, it indicates the ratio between a specific price and specific EPS number. Thus, with every tick of the share price, the P ratio changes. The idea that this one number can magically indicate what one should buy, sell or hold is too simplistic. There are many variables involved in the valuation equation, including intangibles. Dealing in securities simply on the basis of P multiples is rarely a good idea, if ever.